You save. You work hard. You follow all the advice you've been given about money. But somehow, financial freedom still feels out of reach. Let me ask you a question. Have you ever felt like you're doing everything right but still not getting ahead financially? It might not be about how much you earn. The problem could be where you're keeping the money you already have. There are places that look safe. Places trusted by your bank, your accountant, maybe even your family. But these so-called safe spots could be quietly costing you thousands of dollars. If you're over 40, want to protect your money, and build true financial stability, this video was made with you in mind. Today, I'm going to show you 7 places most people consider safe, that are actually eating away at your wealth. And just as importantly, I'll explain where your money should go instead. 1. Traditional savings accounts. Most of us were raised to believe that keeping money in a savings account is the responsible thing to do. It feels secure, familiar, and easy. But let's look at the numbers. Most traditional banks pay between 0.01% and 0.5% in interest. Meanwhile, inflation eats up around 4% of your money's value each year. If you leave $10,000 in a regular savings account for 5 years, you might earn around $250 in interest. But inflation will quietly erase over $2,000 of its purchasing power in that same time. Even worse, banks don't just sit on your money. They lend it out at high interest rates, 8%, 10%, even 12%, and hand you back pennies. So what's the fix? Switch to a high-yield savings account. They're still FDIC insured, just like your regular account, but they offer interest rates of 4% or more. Banks like Ally, Marcus, or Capital One 360 are good examples. This small switch can make a big difference over the years, and it only takes minutes to set up online. 2. Cash at home. Some people feel more secure keeping cash at home. Maybe you've lived through uncertain times and want quick access to your money. But here's the truth. Cash sitting at home earns nothing. And it's exposed to all kinds of risks: fire, theft, water damage, or just getting lost. There's also a slower threat: inflation. If you've kept $5,000 at home for the last 10 years, it now buys the equivalent of just $3,700. That's a $1,300 loss, without you ever spending a cent. According to the Federal Reserve Bank of Boston, Americans are holding more than $500 billion in cash outside the banking system. That's $500 billion losing value day after day. So how much should you actually keep at home? Experts suggest $500 to $1,000, just enough to get by during a short-term emergency. Everything else should be stored somewhere safer, where it can grow and be protected. 3. Certificates of deposit, CDs. CDs sound like a good idea. They offer better interest than savings accounts, with little to no risk, right? Well, not exactly. Here's how CDs work. You give the bank your money for a set period, say, 1 or 5 years. You're promised a fixed interest rate, usually around 1.5%. But if you need to take that money out early, you're penalized. That might mean losing 3 months of interest, or more. So imagine this. An emergency comes up, and you have the money, but if you access it, you lose a chunk of it. That defeats the whole point of having emergency savings. And let's not forget, CD interest rates still often fail to keep up with inflation. So even if you leave the money untouched, you may end up with less buying power than when you started. For some people, CDs work fine. But for most, they're not liquid, flexible, or profitable enough to justify the risk. 4. Permanent life insurance. You might have been told this type of life insurance is a 2-in-1 deal. It protects your family and helps you grow your wealth. But here's what that sales pitch doesn't mention. These policies, like whole life or universal life, are incredibly complex. They come with high fees, slow growth, and confusing terms. Yes, part of your premium goes toward a cash value account. But in the early years, most of your money is eaten up by fees. And over time, these accounts tend to earn just 2% to 3%, far less than basic index funds. Here's the shocking part. In most cases, when you pass away, your family doesn't receive that cash value. It disappears, keeping the profits with the insurance company. So what's a better plan? Buy term life insurance. It's affordable, simple, and gives your family solid protection. With the money you save on premiums, you can invest in something you understand and control. 5. Vehicles and depreciating assets. Let's be honest. Many people think of their car as an asset because it's paid off. But here's the truth. An asset is something that puts money in your pocket. Cars, boats, and RVs do the opposite. The average cost of owning a car is over $9,000 a year. That includes gas, maintenance, insurance, and, most of all, depreciation. A new car can lose 40% to 60% of its value in 5 years. That $35,000 car might be worth just $15,000 or less in a few years. On top of that, if you put your car in a living trust or estate plan to protect it, you could be exposing your whole estate. If someone sues you after an accident, and your car is in your trust's name, they might go after all your assets. So what's the better approach? Use your car as a tool, not an investment. Drive something reliable and affordable. Put your extra money into investments that actually grow in value over time. 6. Timeshares. It might sound like a dream. Own a vacation spot, go there whenever you want, and even pass it down to your kids. But here's the truth about timeshares. They often come with big promises and even bigger regrets. When you buy a timeshare, you're not buying a vacation home. You're buying the right to use a property for a limited time each year, usually just 1 or 2 weeks. And while that may seem like a fun idea, the financial side is far from fun. First, the upfront costs can be thousands of dollars. Then come the annual maintenance fees, which increase almost every year. These fees are required whether you use the timeshare or not. Miss a payment, and you could face penalties or even damage to your credit. Reselling a timeshare is also a headache. Many owners try to sell their timeshare for years, often at a huge loss. Some can't even give them away for free. Why? Because timeshares lose value fast, and there's very little demand for second-hand ones. What looked like an investment turns out to be a long-term financial burden. If you enjoy traveling, consider using short-term rental platforms or vacation packages. You stay flexible, you control your spending, and you avoid being locked into something that loses value every year. Financial freedom means freedom of choice. A true investment should give you more options, not fewer. 7. Employer stock. At first glance, owning stock in the company you work for feels smart. It shows loyalty, and if the company does well, you benefit. Some even get stock as part of their compensation or through special discount plans. But putting too much of your money into your employer's stock can be a risky move. Think about it this way. Your income, your health insurance, your retirement plan, all of it is already tied to your job. If your company hits hard times, you could lose your job and see your stock drop in value at the same time. That's exactly what happened to employees at companies like Enron and Lehman Brothers. Many lost their jobs and their life savings in one blow. Diversifying, spreading your investments across different companies and industries, is a key part of building real wealth. No matter how strong your company seems, putting all your eggs in one basket is never a good long-term strategy. Instead of going all in on employer stock, consider selling some of it and investing the money in broader, safer options like index funds. These are designed to grow over time and protect you from the risk of a single company's downfall. Smart investors don't chase loyalty. They chase balance. Each of these safe places may feel comforting. But over time, they can quietly drain your hard-earned money. True financial security isn't about where your money sits. It's about where your money works. Make sure your dollars are protected, earning, and available when you need them. Because money doesn't just disappear, it flows. And you have the power to decide which direction it flows in. If this video opened your eyes, share it with someone who needs to hear this. Your financial future is worth protecting, and small changes now can lead to big results later.